So China can go onto a gold standard, I think, quite quickly. The reason she hasn't is she knows that if she goes onto a gold standard, she will destabilize the global dollar-based fiat currency system. And that's not her style. She rather watches America make all the mistakes. This is where the future is. This really is where the future is. And I think that there will come a point when China and Russia will put their currencies onto gold standards to protect those currencies from the collapse in our currencies. So it's probably not all that far away now.
Analyst Alasdair Macleod warns that today's global economy is facing a far greater storm than the one that struck in 1929. Back then, the crash was brutal. Wall Street lost 90% of its value, but at least the dollar retained some credibility, as it was still exchangeable for gold. This time, he argues, the situation is far more precarious. With an unprecedented credit bubble, deeply interconnected supply chains, and governments addicted to intervention, the strain will not be borne by equities alone, but by the very currency system itself. Unlike the 1930s, when money still had a tangible anchor, the modern fiat system is unbacked, leaving currencies vulnerable to collapse under the weight of excessive debt and failed policy responses. Macleod emphasizes that repeated government interventions have only exacerbated the situation. Central banks have tried to mask underlying imbalances through artificially low interest rates, relentless balance sheet expansion, and a willingness to paper over every crisis with more liquidity. Yet history suggests such actions delay recovery rather than promote it. The swift rebound of the early 1920s came precisely because governments allowed markets to adjust naturally. In contrast, the heavy-handed responses of the 1930s prolonged the downturn into a decade-long stagnation. Today's policymakers are repeating the same mistakes on an even larger scale, desperately trying to suppress cracks in the system rather than addressing and resolving them. By refusing to allow corrections, they have built a far more fragile financial structure, one where the risk is not simply market downturns, but the collapse of trust in the currency itself. He further argues that while Western currencies teeter under debt and overvaluation, nations like China and Russia have quietly positioned themselves for resilience by amassing vast reserves of gold. By embedding gold outside of official reserves, spreading holdings across sovereign wealth funds and institutions, they maintain a strategic advantage that could one day underpin a gold-backed monetary system. This strategy provides the option to re-anchor their currencies to gold, a move that could shield their economies from the collapse of fiat systems and simultaneously realign the global balance of financial power toward the East. Now, we present the clips from Alasdair's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
When a currency goes down, it goes down against another currency. And I know you can look at gold as a currency, but which currencies...
Sorry, I must correct you. Gold is money, the rest is credit.
Right.
Currencies are credit.
Currencies are credit, right. So which credit from which countries do you think would fare I know you've mentioned Asia, but I'm thinking in terms of the dollar, the Swiss franc, the Japanese yen, which during a crisis, traditionally the dollar rallies, the Swiss franc rallies, the Japanese yen rallies. Would you be expecting this to happen again?
Well, I mean, you'll get some volatility in currencies relative one to another. Of course you will. I think sterling is horribly overvalued. I can see that collapsing ahead of everything else, particularly when Rachel starts crying again. Really, I think the interesting thing is that China and Russia have gold. They've got lots of gold. I understand that in two wealth funds, Russia has a further 10,000 tons of gold, which could deploy, if you like, on the central bank's balance sheet. So they would have about 13,000 tons. That's Russia. I reckon that by 2002, the People's Bank of China had accumulated gold in the big bear market from 1983 onwards. When it was 1983 was when legislation was passed appointing the People's Bank of China to handle the nation's gold reserves. And between then and 2002, Chinese individuals were not allowed to buy gold. So they had a clear run at it. And they tucked this away, not on their own balance sheet as reserves, but they spread it around. My information is that it's gone into things like, for example, the People's Army account and also the Youth Communist Wing's account and so on. So it was all spread around. I reckon they could have accumulated a good 20,000 tons by 2002, which they then turned around and said, okay, we're going to set up the Shanghai Gold Exchange and individuals can now own gold. And they have been accumulating gold ever since. And if you look at the withdrawals from the Shanghai Gold Exchange, they total around about 27,000 tons since 2002. So China can go onto a gold standard, I think, quite quickly. The reason she hasn't is she knows that if she goes onto a gold standard, she will destabilize the global dollar-based fiat currency system. And that's not her style. She rather watches America make all the mistakes. I mean, it's Sun Tzu or whatever.
Never interrupt your enemy while he's making mistakes.
Absolutely, Tim. Yeah, that's absolutely right. So that's their view. They've got Russia in tow as a very close partner, running this huge, great circus, which at the moment is 70% of the world's population. This is where the future is. This really is where the future is. And I think that there will come a point when China and Russia will put their currencies onto gold standards to protect those currencies from the collapse in our currencies. So it's probably not all that far away now.
What would you say to the idea that the whole idea of gold being being money now is just a figment of people's psychology? Money is whatever people think money is, because they've been kind of programmed to think it. I mean, if you go back a long way, yes, of course it was. But if you go back even further, various other things have been used as money. So tally sticks and leaves and all those sorts of things.
Well, gold's easier to use than giant stone statues.
And actually stones as well. So what?
Cowrie shells. Look, it's a question of progress. I mean, it's a question of progress, and what becomes acceptable to the counterparties that you're dealing with. And also, when we set out colonies and dominions and all the rest of it around the world, I mean, you're dealing with all sorts of people, not just your local community. I mean, you could do it. I mean, you could do local community just purely on credit. I mean, there's a fascinating story, which is well documented, that in Guernsey, the States, which is the government in Guernsey, back in 1770-ish, something like that, decided they needed to build a new meat market, which now is still standing there. It's now actually, mainly the co-op and offices and so on. This was going to cost, I think the figure was something like £4,000. So what they did was they issued tickets which could be used as currency. And the tickets were, I think, £10 each or something. So they issued enough tickets to pay for the cost of the building. And out of the rent, they were able to redeem these tickets over the following 10 years. No money was involved. No money was involved. It was just done on credit. Classic example of how credit can be used positively.
The global financial system is confronting what many consider the largest credit bubble in history, one that dwarfs even the imbalances of the late 1920s. Decades of artificially low interest rates and unchecked debt expansion have created a structure so fragile that central banks can no longer allow deflation without risking a systemic breakdown. To counteract this, policymakers have increasingly turned to aggressive monetary intervention, expanding balance sheets, issuing new reserves, and flooding markets with liquidity. While these measures delay collapse in the short term, they also erode confidence in fiat currencies, as the relentless creation of money begins to undermine their credibility. What appears as stability today is, in reality, a slow-burning crisis that threatens the very foundation of the global financial order. Macleod underscores that the deeper issue is structural. Credit has long been the lubricant of modern economies, but its excessive use to finance consumption, inflate asset prices, and cover government deficits has turned it into a destabilizing force. Unlike productive credit, which sustains growth, today's vast pools of unproductive debt have created fragility across both public and private balance sheets. The result is an economy that appears to function on the surface, but is already in a concealed slump when government deficits are stripped away from GDP figures. Gold, in this context, is not merely rising, it is exposing the weakness of paper currencies. What many interpret as a bull market in metals is more accurately a prolonged bear market in fiat money, signaling that the endgame for the current system may be closer than policymakers acknowledge.
Now, we all recognize there's a debt bubble, but do we recognize we're in a credit bubble? I think very few of the people punting in, the momentum stocks in the market actually understand that it is a credit bubble. And, you've got to point out to them, debt is the other side of credit. You can see the debt. It's obvious. This is the biggest debt cum credit bubble in history by miles, far bigger than 1928 to 29, roaring 20s, and what happened subsequently. This is far, far bigger.
And isn't the problem with the debt bubble that the central banks simply cannot afford for deflation to exist? So we will get inflation, and as far as I see it, that ultimately ends in either hyperinflation or currency collapse or both.
Yeah, I think what you're referring to is credit substitution. There is no doubt that as the credit bubble pops, then financial asset values are going to go down. You will find also the risk of holding credit rises, which basically means that interest rates or bond yields along the yield curve will rise. And under those circumstances, the central banks tasked with being the lenders of last resort will try and replace contracting private sector credit, commercial bank credit, etc., with fresh currency both in the form of notes and also reserves on its balance sheet. Yeah, you're right. And it's that will collapse the currencies because we cannot afford, if you like, to allow our economies to go into what they call recession. We used to call it a slump. We're already doing that, incidentally. If you take government deficits out of GDP, remove that from GDP, and over the last 2 or 3 years, you can see that we're already in a slump. And you go up and down the country, go into the high streets, see what's going on there. Go and talk to people, see what's going on with them. And things are extremely difficult. But, this doesn't show in government statistics as much as it should. So we're already got the conditions, if you like, that are creating this existential crisis, the end of the fiat currency system.
And presumably it's gold that's primarily signaling that there's a fire raging.
Yes. I mean, the way to look at it actually is not gold is in a bull market. Gold is
all currencies are in a bear market. But
all currencies in a bear market. Currencies are going down. I mean, the way you've got to look at it is you're not buying gold, you're getting the hell out of credit. Because currencies are credit. And incidentally, modern economists don't actually recognize that currencies are credit. They're not well versed in the difference between money and credit.
So just to make sure that I understand your thesis here. So you're saying, going back to the Roman times, basically everything that isn't gold is credit when it comes to money. So then the only thing that is money is gold.
Well, we've evolved to gold. The answer to that one, Paul, is that we all work on credit. We never, even under a gold standard, you wouldn't dream of paying your workmen or whatever in gold sovereigns. You would always pay with a bank transfer of some sort, a check or cash. In other words, a gold substitute, which is really what a Bank of England note is. So you would never really use gold. You always use credit. In any healthy economy, there will be a lot of credit around. But the problem becomes when there is too much credit The debt, if you like, is unsustainable. And therefore, the situation goes into collapse. If you have credit which is expanded to finance production, then basically you have an extremely healthy economy. Where it goes in to finance consumption, then you're driving up prices. And if you're not driving up prices, then what happens is that your gold reserves, the central bank's gold reserves, decline. And this was the situation that we had from about 1947, when the US Treasury's gold reserves were in the order of 22,000 tons. I mean, we're looking at something like 60% of above ground gold stocks at the time. By the time we got to 1971, it was down to just over 9,000 tons. The reason that there was a run on, if you like, on the US gold reserves is because prices were suppressed by the link between the dollar and gold. And people were taking out gold. They were exchanging those dollars back for gold because they realized that there was this tension, if you like, between the two. As long as you could exchange it for gold, then, of course, what would you do? You would exchange your dollars for gold. And that's what nations were doing because, of course, you and I couldn't do it. We were banned from doing it. So it's a question of scale. I mean, we need credit, yes. It is the basis, if you like, of post-feudal economies, very much so. But it's when the situation gets extreme and credit is pushed into the wrong direction, like government printing it to finance their excessive spending.
If the current trajectory of excessive monetary intervention and rising debt burdens continues unchecked, the implications for gold and silver would be profound. As trust in paper currencies erodes, these metals would increasingly be viewed not just as hedges, but as core pillars of financial stability. Gold, long regarded as the anchor of value, could see unprecedented demand from both institutional buyers and sovereign states seeking to insulate themselves from fiat risk. Silver, with its dual role as both monetary and industrial metal, would likely experience even sharper gains as supply constraints collide with surging strategic demand. In such a scenario, the traditional relationship between metals and currencies would undergo a dramatic reset. Prices would no longer be dictated primarily by speculative flows or short-term market sentiment, but by structural reallocation of wealth away from depreciating currencies and into tangible assets. A sustained repricing could lift gold and silver well beyond their historical benchmarks, transforming them from defensive holdings into the foundation of a new financial order. What do you think happens next? Will these metals rise in price, or will they reshape the entire financial order and force us to rethink what money really is? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.